This section deals with accounting for retained earnings and cash dividends. If you remember, retained earnings is the cumulative net income. Cumulative means the total of all the net incomes from the beginning of the corporation, minus any net losses that they've had, minus any dividends that they've declared. Retained earnings can have a credit balance, which is its normal balance, or it can have a debit balance. A credit balance means that the lifetime earnings are greater than the lifetime losses and dividends that the company has paid out. A debit balance in retained earnings means that the lifetime earnings is less than any dividends they paid out and lifetime losses. The significance of that is that in order to pay a dividend, a company has to have enough retained earnings to declare the dividend that they pay. If the company has a debit balance in their retained earnings, that means they don't have enough retained earnings to pay a dividend. If the company has a credit balance in their retained earnings account, the dividend that they declare has to be equal or less than the retained earnings. We're only going to talk about cash dividends in this chapter. For cash dividends, three things need to happen before cash dividends can be paid. We talked about the company having enough retained earnings to declare a dividend. They also have to have enough cash to pay the dividend. The third thing that has to happen is that the board of directors has to declare a dividend. The board of directors are the people who have the authority to declare a dividend, and if the board of directors does not declare a dividend is not required to be paid. So the company is not obligated to pay a dividend until the board of directors declare the dividend. All these three things have to happen before a company can pay a dividend. There are three dates that pertain to dividends. The first date is the declaration date. This is the date when the board of directors declare a dividend. On this date, a liability is created because the board of directors said that they will pay the shareholders an X amount of dividends. On the declaration date, the company has to accrue the dividends. They are going to debit retained earnings for the amount of the dividend and credit dividends payable. Dividends payable is a current liability in the balance sheet. The second date that pertains to dividends is the date of record. The date of record is the date when the company will go and look at the shareholders that are owners of the company as of that date. There is no journal entry required because all they're doing is determining who the shareholders are as of the date of record, so those shareholders will get paid the dividend. The third date is the payment date. This is the date that the shareholders on the date of record will receive the dividend. On this date, we are going to debit dividends payable because we don't owe those shareholders the dividend anymore as we're paying them right now, and then credit cash. So, to recap, on the declaration date, we have a liability created. We've got a debit retained earnings, credit dividends payable. On the date of record, there is no journal entry. On the date of payment, we have to debit dividends payable, credit cash. Let's analyze your retained earnings account. Your retained earnings account has a beginning balance, a normal credit balance, but remember, if there's accumulated losses, your beginning balance in your retained earnings would be a debit balance. For this analysis, we are going to assume that this is a normal balance of a credit balance. So a beginning credit balance, net income increases retained earnings, and dividends decrease retained earnings. To take it one step further, net income comprises of revenues and losses. Revenues would increase retained earnings, expenses would decrease retained earnings. Your ending balance in your retained earnings is calculated by adding the beginning balance plus net income minus dividends. That will give you your ending balance in your retained earnings. Also, a point to keep in mind, if you have a net loss, the net loss would be credited to retained earnings.